I'm not going to hold you here for long. I'm just going to look at two different things, two different trades. So one is a trade that we have on in SPX. This is a similar structure to a bear trap. Obviously, we have this structure here, out of the money being the trap. Bear is all the way out here. There are 28 days left. Not sure if the bear is coming to the trap. I'm not looking to move the trap anywhere near the bear. So, but I do have an idea for this trade. We'll see how that works. And also I'm going to look at setting up another trade that is exactly what we are seeing on the screen. We're going to step through the process of setting up this trade, and hopefully this will be a little more clear for those that are fairly new to what we do here, and take some questions. Hopefully we'll get everybody up to speed, and then I'm going to look at two trades combined, how they will work together, and if it makes sense to hold both trades together. So we'll start with SPX. This is a 19th March expiration. There are 28 days left. This trade has been on for 39 days. We had a half of one standard deviation move to the upside in the last 39 days. So the price has not moved a whole lot. We can see that when we started this trade, S&P was right around 3,800. And today we're sitting at 3913. So we had a move to the upside. This trade had no risk to the upside, which is fine. And if we were to see a move to the downside in the last week before this trade was to expire, we could potentially make a little bit more than what we had collected on entry, but we would be way too close to break even. And in order to really get the bonus, right, to get the bear in the trap, so to speak, we would have to hold this trade very close to expiration. And obviously we would make the most if SPX was somewhere between 35.50 and maybe 34.40, which sounds like a lot, but you know, from now until then, right, over the next 28 days, if we were to see a 9% move to the downside, this would probably come with a big spike in implied volatility, which would in turn push our T+0 line lower, right? Because the premiums would rise all across the board, which means that the mid price of the put debit spread that's at 35.50, 35.25, the price of this put spread would rise, which will help us. But we have a much bigger put credit spread, and a sharp rise in implied volatility would hurt more than it would help. So what we can do, and I think I talked about this not too long ago. I have not done anything about it, but now I want to look at it again. Since we had enough time burn off the clock, if I was to buy back the 50-point wide put credit spread, right? So I would be buying back the 34.50 and I would be selling the 3,400. This put spread is currently going for a debit of $1.80. So this is how this math works. I'd collected $2.15 in credit to put this trade on. So I have $2.15 credit. If I'm going to spend $185 to close out my out of the money put spread, we can subtract 185 from 215. From 215, we take away 185. I'm left with 30-cent net credit. So if I was to buy back the 50-point wide put spread here, this would leave me with no upside risk still, right? I would be giving up all of my unrealized profit, which is, you know, about $185 right now, right? So I would lose about $1.50 here if SPX does not move lower or if it moves higher. But if we do get a flush over the next 28 days, right? If we move down below 35.50, this would be, you can call this a black swan, right? A 10% move in 28 days. It's not a lot, right? Based on what we have seen and based how far we have come in the last couple of months, maybe 6 months. So is it possible? It is possible. Is it probable? No, at least that's not what the market is pricing in right now, right? So it's very unlikely that this will happen. But if you wanted to take a really low price shot at this with no risk, right, this would be a free black swan hedge. So if you can use that kind of protection, like a 10% move to the downside in SPX, this would be a no-cost insurance policy against that move. Right? So that's I think that is a good idea, unless you have different plans for this, right? If you're using this as a way to generate cash flow, then you know, you can, you know, especially if you're trading more than one contract here, you can look to close out the majority of your contracts and leave a small piece, as you know, you're obviously giving up whatever is unrealized right now, but in exchange for that, you're getting this downside insurance policy, which will pay huge, right? So you have no risk. So you're giving up maybe $150 here, but if it hits, you'll make up to $2,500. I think it's a decent bet if you needed that kind of protection. If you don't, then I think that this is not a terrible spot to just exit this position in total. So the next thing I want to look at is setting up a similar trade to this. All right, so we can go and model a new trade. And the idea when setting up this trade is to place the body of this structure at about one expected move to the downside based on current implied volatilities. And with the VIX being as low as it is, I mean, it's relatively low compared to where it was most of the time last year. It's low. So we're not going to go out too far out of the money. But I think that over the next, let's see, we have April monthly expiration is in 56 days. I think this is a decent target. You can use the monthlies. So the 16 April, these are monthly and these are weekly. So these expire on a Thursday. These will expire on a Friday on the close. Unless you're planning on holding until expiration, I don't think it makes a difference which ones you will use. I would say, I mean, they're both as liquid as monthlies are as liquid as weeklies and vice versa. So I don't think it makes a big difference. And you can compare prices. One contract has 1 day more, so you'll get a little bit more premium, but it's going to be insignificant. So don't spend too much time thinking about it. What we want to do is we want to understand what is a one expected move right now in SPX for April expiration. And, you know, we can look at most broker platforms offer an expected move reading. So I'm just looking over on Thinkorswim, and it looks like April. I'm going to look at the weekly, the PM settled. So April weekly contract has an implied move of about plus minus 300. Does anybody else see different? One other way to estimate that is to add an at the money call and an at the money put. I don't think this is going to match right now. Let's see, we are at 39.10. So we have an at the money put going for about 112, and an at the money call is going for 109. So combined together, right, we have 112 plus 108. So we have about 220. Vasily says 297. Yeah, I'm seeing 299.39 on Thinkorswim. So adding at the money straddle, or adding at the money options, and using that as a gauge for what is expected, it's close enough, but it's not the exact science, right? It's not the exact number, and we don't even know. This could be due to different factors here. So different brokers calculate IVs differently. They calculate, and IV goes into the formula that spits out all other Greeks. So I see on Option at Explorer, which I think they calculate their own IVs. So I see 16 April showing 1816 as implied volatility. And on Thinkorswim, I am seeing 24.26. It's a 6-point difference. That's a lot. So who's right and who's wrong, I don't know. But I'm going to use, I think that the key here is if you're going to use one or the other, just be consistent with it, right? Don't use one and the next time use something else. So if you're only going to look at data from Thinkorswim, stick with that. And if you're only going to use data that you see from your other broker, could be Schwab, could be Tastyworks, just stick to one. Don't go from one to another for different trades. So I'm going to go with the data I'm getting from Thinkorswim. I'm going to assume that right now the options market is pricing in about plus minus 300 for April expiration. So what I'm going to do, I'm going to go out 300 points from where we are right now. So let's just say we're at 3,900 minus 300. So I'm going to go out to 3,600. And that's where I'm going to look to place the body of my, this is going to be a unbalanced put con, or this is also what's known as a bear trap. All right, so I'm going to use a one expected move to the downside. I'm going to go out to 3,600. $36.10. So 3,600 is a 19 delta put, right? And using this data, we can also say, well, actually, you know what? Let's look at what is a 3,600 put on Thinkorswim. So a 3,600 put on Thinkorswim is a 20 delta. So, I mean, it's pretty close, even though IVs are different and expected move is different, but delta is about the same, and the premiums in 3,600 is about 46.30. All right. So what I'm going to do is I'm going to look to buy a 25-point put spread. Right. So if I'm going to buy the 3,600 put, I'm going to sell a 3,575 put. And this put spread is going for a net debit of $3. So I have a 25-point wide put debit spread, and I have a risk of $300, which means if SPX does not go down below 3,600, 35.97 to be exact, over the next 56 days, I'm going to lose the $300 that I'm going to pay for this spread. Now, very similar to what we do with earnings trades that we have done recently, we're going to look to sell an out of the money put spread. We don't want to sell naked SPX options unless you're trading in a portfolio margin, but even then, with 56 days to expiration, this thing could balloon on you that way beyond your wildest dreams. So I don't think it makes a whole lot of sense unless you're experienced enough and you understand how naked options in indexes work and how to plan for some kind of a black swan event. And then we're going to look at adding the black swan event I talked earlier about, to see how that plays into similar structure to what we're building right now. So the idea is to buy a 25-point wide put spread, about one expected move away from where the price of SPX is right now. And then we're going to look to sell a 50-point wide put spread, and we're going to look to collect at least $5 for it. And at $5, we'll go to cover the 3-point loss or $300 loss on the upside, and should leave us with about a net credit of $2. Right? So we're collecting $5 for the put spread. We're spending $3 for this put debit spread. This should leave us with a net credit of 2 points or $200 on the upside, which means that we'll have no risk to the upside. If SPX goes to 10,000, right? The most we can make is the $2 that we're going to capture by selling a $5 put spread and buying a $3 put spread. Does that make sense so far? While I'm going to go out and look for a 50 wide put spread for $5 or something about that. All right, so that's close enough, right? And we can go closer and maybe even turn this into something that's going to be very close to a unbalanced or broken wing put butterfly. All right, we can go selling a 35.50 and buying a 3500 will give us a net credit of about $2, right? So it's the mid price is currently showing $2. And if we get a push lower today, which we may or may not get, right, we can get probably $2 or more. But that's the idea, right? We're selling a 50 wide put credit spread for $5, and we're buying a 25-point wide put spread for $3. We end up with a $2 credit, and that is the most we can make. If SPX goes out in April anywhere above 3,600, right? Which means that all the options that we're buying and all the options that we're selling are going to go out at zero, and we just get to keep the $2 that we're collecting on entry. Does that make sense? So that's the idea. Let's talk about the risk in this trade. We have two spreads here. One is a 25-point wide. The other one is 50-point wide. Right? The difference between two spreads is 25 points, which means we can't lose on both. Right? So if we expire above, right, the body of our structure here, we can't lose. There's no risk on the upside. Now, if we go way past and below all of our options, we have a $5,000 worth of risk here with the 50 wide put credit spread. But we also have a 25-point wide that's going to be in the money. So the difference between the two is $2,500. And $2,500 is the most we can possibly lose if SPX goes down below 3,500 and expires there, right? We will lose the difference between the widths of two spreads, which is $2,500. And since we're collecting $200 for this trade, this will go towards offsetting our max potential loss of $2,500, which means that we can only lose $2,500 minus credit we're collecting. Our max potential loss is $2,300. And you can see that on this platform, it says that with a $200 credit, my margin is $2,300. Vasily's asking, I looked on SPX IV on March 15th last year. It was around 80. Do you think it makes sense to estimate the risk with this IV adjustment? You know, I don't know if we're going to go back to IV 80 unless we're going to get something that is an unknown, right? Something that the market is not pricing in. Market was not pricing in the coronavirus and a global shutdown. I think we're past that, you know, with the vaccine rolling out, unless we get invaded by aliens, maybe. But at this point, I don't know if I would be pricing in IV to 80, but you know, you never want to say never. But you can bump IV just a little bit to get a visual of how your T+0 line is going to move with an increase in implied volatility. But I don't know what that number is. You can estimate, and your guess is going to be just as good as mine. Let's take a look now at how, if I was to hold on to what I have, right, in March, combined together with what we're talking about here, right? This will be kind of adjusted, weird looking P&L because they have two different expirations, right? So I would still have net positive delta because both trades are bullish. No risk to the upside. All the risk is on the downside. I would have 2 times as much risk because if S&P was to blow past through all my options to the downside, I have the risk on the downside from March trade, and I have the risk on the downside from the April trade. So you get hammered if that was to happen. If we were to trade down, you know, 10, 11, 15% over the next month, this would not be fun. But remember, as I had mentioned earlier, what we can do here, if I was to remove the put spread, the 50 wide put spread in March. And this might sound like, you know, kind of a weird, hard to imagine idea, but basically, this is what the risk profile would look like. And this is all over the next 28 days. Right, so over the next 28 days, if we trade lower, we could potentially not lose anything until about 37.70. So the insurance policy in the March will cover any potential losses down to about 37.70 or so. If we get a flush, right, our March risk-free Black Swan insurance will cover the April position. So if we get a down 10% move, our April position is going to be in a ton of pain, but our free Black Swan insurance policy in March is going to more than make up for it. Right. So basically, this kind of becomes, even though here we see negative Vega, this is actually kind of Vega positive. We don't really care about volatility exploding to the upside because it rarely happens. But if we explode to the downside and IV picks up, we can see this. I think it's actually this software is not showing the true P&L, because if implied volatility spikes, we have a long put vertical in the front month, and this long put vertical is positive Vega trade, and a sharp spike in implied volatility on the front month is going to help this trade a lot more than what this system is showing. But that's the idea, right? So if we wanted to hold both and have a protection for our April position, we can convert our March position into a free protection against a big down move over the next 2 months. Right, so if we go up, nothing happens. We will lose whatever we have in unrealized profits in March, but we'll make up for it with our April position. And if we get a flush lower, we will potentially lose on our April position, but our March position is going to more than make up for it. So I don't want to call this a riskless trade, because we do have risk. We have this little sea of death, right? Somewhere between 35.45 and 37.70 or so. Right, so if SPX expires somewhere inside this little triangle over the next 28 days, our April position is going to be under pressure, and our position in March is going to expire and not pay out to cover the losses for April position. I know it's a little hard to imagine or understand maybe if you're newer, but I hope that putting this in a visual perspective helps understand a little bit better how these two can coexist in your portfolio and actually work together to help you control your risk a little bit better.